Here on the trail of QE2, will buying $600 billion of treasuries really grease the skids for the U.S. economy, or will the cash end up overseas, driving up foreign asset prices? I'm here in London to find out today. Stephen Major, Global Head of Fixed Income Research at HSBC, is with me now to share his thoughts on yesterday's decision by the Fed. Steve, welcome. Thank you.
Thank you.
Does the surge that we're seeing today in foreign stock prices, commodities, for example, validate, in your mind, the thesis that all of this cash the Fed is trying to pump into the U.S. economy will ultimately find its way elsewhere?
Yeah. Well, it seems that the plan that Bernanke had was to inflate asset prices, get equities up, right, get the dollar down at the same time. QE1 clearly leaked, and I'm sure the Fed has good data on this. But anecdotally, it seems that QE1 helped more the property prices in Hong Kong than it did property in New York. So clearly the Fed wants to make sure that the leakages aren't so great this time round. I'm not sure how they're going to do that.
Right. What power does the Fed have to do that? None, really, right?
Well, the QE1 was more about mortgage purchases, right? And we know where they were held. They were held in Southeast Asia, so there's more of a direct relationship there in terms of the cash flow in return for the mortgages. This time it's about government bonds. And the government bonds are held also in the US. So it's very difficult for the Fed to control this. If the money's going to leak, it's going to leak. And you can see the reaction from some of the EM countries and out of China as well. People are worried that this is more inflationary for countries other than the US.
But that's not to say that QE2, or at least the announcement, isn't having some impact on what we see going on in the Treasury market. I had a chart built that I want to bring up because it illustrates a point that you made today, which is that we are seeing yields drop dramatically in the belly of the curve and spike at the top end of the curve. Here it is. It's perhaps not the clearest illustration of all, but the yellow line is where things are now. The white line is where things were a month ago. And you're looking at the difference between the 2-year Treasury, the 10-year Treasury. This is, why is this happening? Why would the Fed be targeting what they call the belly of the curve?
I think the chart understates what actually happened, because, you know, the 30-year bonds fell 2 points last night. That's
the one thing we didn't throw up there was the 30-year, because it makes the rest of it difficult to read.
So what's happened is the Fed has clearly targeted the so-called belly of the curve. They said they want to go for an average duration of 5 to 6 years, and that means they're buying bonds from 2s out to about 10-year, right? But it means that they're virtually leaving the 30-year on its own, and the 30-year has become unhinged because of this. Maybe
there we are. Here it is with the 30, so you can see how much higher the 30-year yield has gone relative to the other bonds.
Maybe what they're trying to do, this sounds a bit conspiratorial, but maybe what they're trying to do is achieve this dual objective. They want to lift inflation up, right? So one way of doing it is to let the yield curve go steeper, because that boosts inflationary expectations, and that could actually feed into the economy. Actually, it's also quite good for pension funds, because it affects the rate at which they discount their liabilities.
Okay, but all that said, all of that doesn't sound like it creates jobs.
It doesn't create jobs at all, no. That's the reality. All the Fed can really hope for here is that it boosts inflation and that it can somehow keep the yield curve low and flat at the front end. Now, that sounds already quite complicated, because, as you know, it's contradictory to be trying to boost inflation on the one hand and keep yield lower.
Stephen, before you go, I have one quick question. How do you position yourself now that the Fed has come out with this announcement?
Well, I think you keep on buying at the front end of the US, because you don't fight the Fed. The Fed's going to own nearly all of those bonds at the front end. And elsewhere, perhaps in Europe, you actually play steepeners, because the curves have to catch up the US curve.
All right, Stephen Major, thank you very much for joining us here. Stephen is Head of Fixed Income Research at HSBC.